Good morning, everybody. Welcome back to the Schwab YouTube coaching channel for the Thursday edition of Trader Talk in today's market. I'm your host, Kevin Horner, joining you from a sunny Denver, Colorado this morning. Pleased to be with all of you today. I am also joined by my friend and fellow coach, Brent Moores, there in the chat. Say hey to Brent, who'll get to comments and questions that you all pose that I'm unable to get to today. But of course, as always, especially on a Thursday when I'm running solo for all of you, I do want to hear from you. So feel free to post in the chat for the duration of the show. Make sure you're following Brent and me on X, Brent Moores CS, Kevin Horner CS, one of the best places, I should say, to find us there when we're not hosting classes for you here. X is a great spot, as is LinkedIn as well. Trying to expand our reach, of course. So if you're looking there in LinkedIn and you're perusing, feel free to follow me there as well. All right, as we need to, let's jump to our disclosures, and then we'll get into the meat and potatoes of our chat today. So first of all, remember that everything we cover for you should be considered informational and educational only. We do not make recommendations nor endorsements for any approach to trading here. We will utilize technical analysis as we review the market with you. Remember to think of technical analysis merely as one of your decision-making puzzle pieces, not the entirety of it, of course. So when you're working through your process, try not to make decisions exclusively off what we get in the way of technicals, though. We do want to utilize them. We can make them one of our decision-making pieces, just not the entirety of it. Now, if you are new to our Trader Talk session, we follow a relatively standard approach. Here we do a top-down review of the broad market. So we will lead with our biggest indices, work our way through those into some industry groups and sectors moving around today. We'll also take a peek, as we always want to do now, on oil, see how things are looking there, and see what we can learn about the relationships between the various sectors. And then we put ourselves in the final few moments here with stocks in the news, and we like to look at those individual equity charts as well. So with that, we're going to jump to the S&P, and gang, I don't know what to suggest about the S&P anymore. We continue to see new highs breached. Today we opened at another new high. There's just not a lot to suggest about doing anything different. Remember, at some point, we're going to get an alteration to the trend, but we're not there at this moment. And as we'll see when we start moving around in our sectors and whatnot, we're going to find some groups that are on the move that might be a little maybe behind in their moves. And they may be playing a little catch up. That often happens as well as we start to rotate money around. We see traders pulling from profitable trades, reapplying those dollars to new areas of the market that could be shifting. So, we're going to look at some of that with you all today as we try and make heads or tails of it. But I'll tell you that 20-day moving average continues to really speedily walk the way up the price action line here. And again, if you're working with a 20-day, that's perfectly appropriate given what we've seen in the trend analysis of late. But at the same time, you might find that it is insufficient for you to manage your tolerance of risk. And you might want the 10-day. We still haven't breached the 10-day on a closing basis here. And the faster your moving average is, the more likely you are to manage your risk a little more cleanly and maintain a higher amount of your profitable situation. And I am saying profitable because, well, if we're trading in the SPX, we should be in profits here, right? Because it's just been an assault on these upper levels. I know 7,300 was a pretty big number for a lot of traders targeting, and we're already cleanly through it, everybody. We are 70 points above 7,300, so that's a nice solid 1% move through that ledge. Don't step in front of a freight train if you're wanting to believe that the market can't go any higher. Remember a couple of key components. As it relates to technical analysis, what is high can go higher. Okay. Additionally, the market can stay in what you might deem to be irrational far longer than we can sustain trades that go against the market's movement. So be cautious if you want to be bearish. If you wish to be bearish, one of the other reminders is you can be bearish without taking bearish positions. You can move yourself into larger positions of cash, give yourself fewer equity dollars in exposure. These are ways that you can manage your own emotional tie to the trades, to your money, and maybe look to take advantage here. You don't have to have your dollars invested every step of the way, especially if you're simply a trader who's trading on opportunity. Look for those pockets and shoots where your opportunity lies, and try not to be, too overdone here, right? One way or the other. So remember to kind of define your process and know where it is that you want to make your decisions along the way. So maybe a 10-day here in the SPX. We're going to see, I'm going to leave the 10-day on here because as we go over to the NASDAQ 100, you're going to see basically the same thing, everybody. April 1, we recaptured the 10-day here and once more have held it the entire way. So we're trying not to overthink. We're trying to just keep the ball rolling, so to speak, and raise and elevate our exit strategies. And in a lot of the case here with the NDX, I mean, take this line and I'm just going to duplicate it and move it up. There's a number of key levels in here. Right now, for a lot of traders, it might be this one right here, very tight relative to the trend, but again, 5 full weeks above the moving average. You know, at some point we're going to change, but until it does, traders will commonly work with the trend that is in play, right? And so don't fight against it, just elevate, raise your stops along the way. And speaking of raising stops, I just want to remind you all, on Tuesdays in the afternoon, I do have a class called Building a Stock Portfolio. And as much as that's about building the portfolio, it is equally about raising our stops in the stocks we're holding in an effort to stick with them as long as possible. This week in particular, I spent some time building a new process, or adding a new process whereby instead of just a standard stop, we built in a trailing stop for one of our example trades. So check that out in the archive on the channel here if you're looking for a conversation around raising stops, sticking with your long equity positions. I focus almost exclusively on equities in that class. So if you're looking for that discussion and a plan and a process by which you can continue to raise your stops, that is a class for you perhaps. So check that one out, everybody. Again, Building a Stock Portfolio. So we're watching the NASDAQ push to new all-time highs here today. We're going to like that, obviously. We're going to see where money in the NASDAQ is rotating here momentarily. Let's look at our small caps, getting a little breather here. But outside of a quick test below the 10-day, they've been pretty solid too here. As you can see, we had a nice little 2-week consolidation in the Russell, broke that to the upside. And since we were watching yields spike most recently, things have come back to earth here. So here on the Russell, it looks like the 20-day has just been a little bit more consistent, right? Because of this pause we got for the last that 2-week window in here. But when we looked at the yields were spiking and we were digesting this so favorably, the Russell was moving higher, and now we've got yields coming back and it's leading perhaps to the Russell with some tailwinds behind it, right? Some push and opportunity to see Russell and small caps moving, but we still are noting that we have an elevated level. But what's interesting to me, an elevated level in the 10-year specifically, but what's interesting to me is just the way that the small caps continue to digest this movement. Meaning I'm of the impression here, just based on price action, that the expectation relative to the Russell is that yields will be lower in the future, which has to happen organically. Brent and I talked just yesterday about the third party, the interest rate tool, right? We look at the CME third-party application, right? The website that tells exactly how traders are kind of positioning themselves, what their expectations are, so on and so forth. And we saw that there's not a lot of expectation for a rate cut. In fact, there could be a potential rate hike in the future, and yet the market is digesting all of this in a relatively favorable fashion. So, again, at some point, the market will have a different view on the news that's out there and all the information available to us. But remember one key thing as it relates to technical analysis, the monitoring of price action, so on. It's the belief of the technical trader that everything that is known, all of the risk factors, all of the concern, all of the rumor, all of the conjecture, anything that is a known topic is built into price. Okay. And so if you're trading based on technical analysis, well, then your belief is that price is right, price is correct, the market is correct, and all we need to do is follow along with the trends. And if we stick with the trends for as long as possible, then we're probably okay. But remember, the key component to all of that is when the trend changes, we have to change with it. So if you're trading the trend, something like the Russell, we are going to continue to stay long until that trend changes. For some of you traders, it's working with the 10-day moving average. For some, it's working with the 20, and others won't even concern themselves. They'll simply allow price action to do its thing. And then when something quickly changes, and the most immediate change in this case could be a trade below the low we made yesterday right there. And I'd say that's only because if you've been like maybe you had you stepped into this at the right time. You just got in here on the low when we filled this little gap and you said, all right, I'll just buy this until this tops out. Well, it rallied 6%. And then if it trades under the low we made on our high day, if yesterday was in fact our high day, well, then this could be the impetus for a brief pullback, not a reversal, but brief pullback. And some traders would say, great, I made 6% to the upside. If we take out the low on our highest day, then we have the greater likelihood of retreating to the 20-day moving average. Maybe they want to take some profits and wait around, wait for the next opportunity. But not everybody is going to want to trade that actively or be that engaged with the market like so. But some of you will. So just make sure whatever your preference is, whatever your plan is, you're prepared to take advantage of it. Now, we have, of course, seen an immense move to the upside here in semiconductors. Semis are down 2% today. I have a line drawn in, which I think was basically looking at yesterday, kind of where we started things here. This thing has just been an absolute monster. Most of you realize that we've seen this group move about 50% plus in the last couple of weeks here. So this has just been in complete and total beast mode. The 20-day moving average way too slow in this case. If I drew the line to yesterday's peak, it is 62% to yesterday's peak, and that was just since April 1. My goodness. So management here, 10-day moving average, perhaps, and again, some volatility. I'll point out that's about what, 500, 600 points away, more than 550 points away to the 10-day moving average. So as always, some of us like to sell at these elevated levels. We'd like to keep as much of our profit as possible. And what I've learned about myself is that's kind of a benefit to my emotional well-being. When I see these positions moving to the upside like this, and I get profitable situation, I notice the dollars there, I'm not a big fan of giving those profits back. And so often what I'll see happening is as we rally, well, you can take a few shares off, and if we're talking a small position, 50 shares, you might want to sell maybe 5 shares here or there as you are at these elevated levels. And then what you'll find is it makes it even easier to stick with it because now you've got fewer shares devoted to the trade. So when the stock pulls back, you're seeing fewer dollars in your profit scenario given back to the market. And you can sustain some of that wiggle room, right? Some of that machination the price action makes. Figure out what it is for you that drives that decision making, right? What makes it easy for you, what makes it hard. Lean into the stuff that makes it really easy and away from the stuff that makes it hard. Look, trading is hard enough. If we build ourselves in a process that makes it easier, then we're probably doing a little bit better than most. So that's what I want to encourage. What I want you all to strive for is making our lives simpler on ourselves. Okay, so we've seen the Russell, we've seen the semis, we've seen the NASDAQ. Let's just take a look. Okay, and we have to look, we're going to move into some sector movement here, everybody. Take a look at the energy space, which is getting whacked again today. So we had talked about the potential of a breakout here, basically holding on to the 50-day. Well, things have really roundly gotten a reversal here. We're going to see if this maintains, but this is not a negative necessarily. We of course want to keep the closest of our eyes on oil and how oil is being driven here in the near term. But what we're going to see, in fact, I'll go ahead and bring that oil chart in here. I'll bring in our futures review, and I'll just, again, heads up, we're using future symbols. That doesn't mean you should be trading futures, of course, but what we're looking at here is the futures here on the left for the S&P, the VIX futures in the middle, and the oil futures on the right. Oil futures came down late or early this morning, I should say, did not make a new low, did get a little bit of a bounce, but you got a very distinct downtrend in place over the last couple of days, down about 15% here in oil. And then over here on the left, you can see that the movement to the upside has been exact inverse of oil's move. So as Brent was talking yesterday, clear inverse relationship between oil and the S&P 500. And as long as this maintains, well, then we can utilize this to a certain extent for an understanding of potential trend continuation as it relates to the S&P 500 at least, and perhaps the broader of markets. So, this is not a negative, but the elevated oil is certainly one of the things we have to keep an eye on. We're still hanging out at a good level on oil. When I say good, I mean at a higher level. Remember, we were in the neighborhood of 65 a barrel before the conflict. So oil is up, but this is the kind of move that we want to see if we are hoping to see the slowing of inflation. Oil is a key driver of inflation, and so if we can get oil lower, well, then that's going to benefit a number of key areas. So let's talk about one of those areas. What are some of those spaces? Well, what about the airlines? Take a look at airline securities here. This is that airline space. Notice the last 2 days, what has occurred? We've had a big spike, a big rally. These are the total airline stock market, total stock market for the airline group. And you can see that we've pushed this into an area, a band of resistance up here. So it could be meeting, its ultimate end as we've rallied into resistance, but we don't know just yet. But clearly a move through here wouldn't be terrible, would it, for this group? Okay, so as oil goes down, we're seeing this group react favorably to the upside here. So what about since we're talking about it, we're going to take a peek at the transports internally, or the broad transports, I should say. But before we do, let's look at our other areas here. What about the truckers, who are, of course, going to have some tie to oil as well, right? We've got a nice trend continuing here. We did get a throwback move to an area of short run support, held the 50-day moving average, didn't quite test it to the letter, but you've had a positive structure here, right? Trend up, consolidate, trend up, consolidate, trend up, and then pull back. Now we got a deeper pullback here, but we know why. This was a deeper pullback in the midst of all of the consternation in Iran. So we had a huge drawdown when oil sold, got its bid under it, right? And truckers would start to struggle a little bit. Well, then as things abated here, we got a foothold, and then by the beginning of April, it was right back on path, right? So a structure from the standpoint of higher highs, higher lows that you can certainly gather some information from here, right? We've got an area of short run support. If traders were of the mindset that oil were going lower, this is a group to keep a closer eye on, perhaps. So as always, know the relationships, know where we have opportunity, and try and take advantage as much as we can, of course. Okay, so let's look at the transports collectively. So the whole group made the full retreat to the 50-day moving average, that line in here, holding it. So looks to me like, if nothing else, a trader could perhaps position transports for investment here, just simply based on the breakout and throwback to our breakout spot. And so the key to dollars, a trader applying new dollars to this ledge becomes an exit strategy under the 50-day. At least that would be a shift in what should be happening here. This is an area of short run support, 50-day moving average support, and it likely becomes an area where traders would look to move on if it broke below the 50-day for any extended period. Remember, if we're doing that, we need to define our confirmation. Is confirmation below? So, for example, a close below the 50-day for some of you traders would be a sufficient confirmation. And you'd say, yeah, my transports, it's time to move on. We broke the 50-day on a close. Other traders would say, nope, I need 2 days in a row closing below the 50-day, or 3 days in a row closing below the 50-day to validate a potential breakdown. Always know what it is that's going to give you the impetus to make your trade or shift your viewpoint. Have that stuff laid out. It'll make your decision-making process substantially easier in the moment. And that's really what we're trying to do. We're just trying to make our job easier in the moment. So know where you want to move on. For some of you, it may very well be below the 50-day for a period of a couple of sessions. So we'll monitor the transports going forward here. Again, movement relative to oil, fairly significant here. Our VIX is hanging in nice and low, and this is generally what we want to see, but we also know that a low VIX can be kind of a signal, right, for some traders as to where they start to look to take profits. Reason being, lower VIX, we have an expectation of a reversion to the mean, and we've absolutely seen the VIX really retreat aggressively from the early March levels, right? They got up there as high as 35. Well, we're back down 50% of that. And when we're in a strong uptrend, it's true that we are going to hang out in these lower levels a little bit longer. But as we start to see some spikes in here, you may see traders look to take some of their profitable positions off the table. Not everybody's going to be as concerned, and remind ourselves that VIX and volatility does not necessarily mean bearishness. Okay, we can get volatility in the midst of bullishness even still. So keep that in mind. And I was looking at today, I wanted to share one other thing as it relates to just overall broad sentiment in the marketplace here. I'm going to kick us over, first of all, to the Market Watch and quotes page just to see our sector tool here. And I'm going to lead with a change year to date so we can see where all of our leaders are. And I just wanted to point out that as it relates to the overall feelings, if you will, of the stock market here, we got the AAII report, that is the American Association of Individual Investors, talking about expectation for the markets going forward, and it's still showing a bullish slant at this point in time. So when we look forward here, in mid-April, the bullish view of sentiment was about 32% of respondents, and now here it's about 38%. Earlier in the month of April, it was as high as 46%. So there's been some movement here, but sentiment can absolutely be a driving factor for us as we continue down the path. So there's certainly a positive lean here, a bullish lean to the overall market. At this point, what I'm noting in terms of the price movement in our sectors is really the shift back into some of our risk on assets over the last month plus. Look at the return on technology, for example. Tech up 17% here over the last 20 sessions. And we're looking at the same thing with communications up 12%, and discretionary. These are your risk on groups. And so there's been a little bit of a shift, and we can see that playing out in the form of explosive moves to the upside. Again, our job, make sure that we're capitalizing on those explosive moves, make sure we're taking profits when given the chance, building cash, looking for next opportunity. Don't be misled to believe that what's going up will continue going up in perpetuity. We know better than that. So again, it's our job to take our profitable trades, take those positions to cash, or portions of those positions to cash where we can. Okay, yeah, John, Noble Savage, I could not agree more. I'm a bit of a market addict myself. Let's see, paper money account, could not agree with that any better as well, Sam. Get that thing going, get familiar with it, build your process. Don't lean into paper money as much for understanding your true risk. I'm a big believer that we understand our true risk by getting familiar with real dollars on the table. When dollars are at risk, that's when we start to understand what we can sustain and what we cannot. I'm not sure paper money does a great job of that, but what it will help you do is to build your plan based on market impacts, market effects. That's where you want to make sure you're getting your learnings from, essentially, as it relates to paper money. I really love the paper money platform because it can really aid us in honing our process. I just don't think it does as good a job of helping us understand true risk because, well, for most of us, true risk comes only in the form of actual dollars lost, right? And that's hard enough. Okay, let's see here. Oh, I know what other space. So we're going to look at a couple of these sectors. Let's just kind of work our way through. I wanted to make sure we talk tech, but we got to look at software. So first of all, technology, just an explosive move here. This has been fantastic. To the upside, brief consolidation, 20-day moving average too slow, 10-day moving average providing support. We still don't have a close below the 10-day here, right on it. Close this day was 6057 and the 10-day was 6045. So, 10 points above it. A wonderful reminder that if you're not getting a close below the 10-day, in this case, boy, you may not very well have a reason to have sold your tech. So this has done exceptionally well also. We're seeing a rally in this case, only about half of what the semis have put up, but still, nonetheless, a fantastic rally in tech. Now let's look at software. Okay, now as you can see, we've been talking some software, everybody. Software is on the improve. We've got resistance band above us. Make that a red line to validate it as resistance. But what are we having in here? A new structure, as you can see, right? We've broken down here. That's what this falling wedge was. But look at how it was falling with price as the RSI was improving. So we were seeing a bullish divergence here. What stood out to me most is that after having fallen like that, and then it rallied through, what did we get? We got a little bit of an exuberant move, right? And that's where we're back to right now. But ultimately, all we did was hold support at 69.5 on this very broad software index. And we had one day beneath it. Let me lift this oval, but you can see a hammer candle at support like this, and it led to a gap move the next day. So we got a hold right there after a support test. And even though that hold did not mean an immediate rally into resistance. What it did here was still consolidate, right? So we have basically maintained this ledge for the higher low. And today, if you wanted to draw it like this, you could just say, yeah, we've taken out the downtrend line. And now if we just clear on a close, the highest high we made here a couple of weeks ago, well, then I think a lot of traders are going to start targeting the zone here, the red line and the gaps level. So this is an improving space. And some of those stocks that y'all are thinking about in this group are probably ones on the move today. So we're going to look at a few of these. Let's see. So I had some of those in, yeah, so we had some, boy, these are all movers in this space. So let's see. I believe we've got Datadog moving. Yes, we do. Big move on earnings. Now that one is red candle here. We know why it's red though, don't we? It's red because we opened much higher and now we're a little bit lower. Intraday chart will help us out a little bit. The open this morning here, what a fantastic candle off of that heads up. And we're basically just allowing this 20 period exponential moving average to catch up with price action in here. Just a little bit of give back, a huge candle like that on a 15-minute. I know it looks worse on the daily than it probably really is, but that's a big move. Let me see if I've got any specific headlines for y'all as it relates to Datadog here. I thought I had an actual upgrade. Okay, I don't. All right, so probably don't have the specific headline I'm looking for because it was late this morning here. So Kate came in just a little shy of expectations, perhaps. And again, what a shock! AI is coming up in the conversation as it relates to Datadog. That's not a surprise, is it? So, and yeah, there you go. Anthropic. That's going to be a big. Let's see here. Yep. So apologies that I don't have all the detail there in front of me, everybody, but I wanted to make sure we saw this one as one of those big movers today. I do have a number of key individual positions, the individual equities, though, that are in the news that I thought we'd spend some time on for you today. So let's look at some of those here. All right. All right. So in the news also this morning, we've got Tesla moving. Let's take a look at Tesla. All right. So Tesla's back above the 200 day, everyone. My goodness, this has been a little bit, right? Back above the 200. Nice green, beautiful candle today. We'll see if that's going to maintain, but we do have a couple of key details. You know, we're seeing a 2050 cross. So you've got a new short-term trend possibly playing out. We've got and we know that we've got a broken downtrend. Okay, so we shouldn't be surprised that we broke the downtrend, took a pause, came back to the downtrend line and the 20-day moving average for a little bit of effort in here for a test, and we sure did. And now we're trading at the highest we've seen Tesla since mid-March here. So a nice little development over the last 6 weeks as this thing continues to improve. Now the news on it, their April China-made electric vehicle sales were jumped by 36%, which is on a year-over-year basis this April. So deliveries of Model 3, Model Y vehicles built at their Shanghai plant totaling more than 79,400 units. So that's a positive for Tesla, and more important than anything, at least in the way of price action, is the recovery of the 200-day moving average. And I say that not because it's important to Tesla, but it's important to stocks in general as we talked about technical analysis, right? What is it in the key component about the 200-day? It's just one of those self-fulfillment concepts as it relates to technical analysis that so many traders follow the 200-day simple moving average because it defines the time frame of their trend quite clearly. It says, hey, for a lot of traders, if the stock is below the 200-day, they don't even consider it because the longer, broader trend is not considered to be bullish. But if you're above the 200-day and you've been maintaining it, well, then it can be considered bullish in that 10-month window and beyond. So the fact that a stock as big as Tesla recaptures the 200, it could very well be a positive development in the near term here. Let's see. So we've got the potential of something bigger under development here in Tesla. We've heard from some other companies on, let's see here. I had a headline on Google and Alphabet, that is with Blackstone letting, yeah, there it is. So I'm going to bring in Google here. So the headline is Blackstone utilizing Anthropic. Yeah, so Google, Alphabet is in talks with Blackstone and KKR, EQT to let their portfolio companies access their models. And after OpenAI and Anthropic announced joint ventures with private equity firms. So Alphabet getting a potential lift there. Tough to get much more lift here, isn't it, everyone? With Alphabet, my goodness, it just keeps doing its thing. So, you know, again, what goes up does come back for tests. We know there's a few areas of potential importance here, one of which becomes a gap zone. We've got that gap ledge here. In relative short order, it's likely we'll see that 20-day moving average caught up with the breakout ledge here, but that would only serve to reinforce it as a potential spot for support and a potential spot for any pullback to possibly cease, right? So let's see if the 10-day there is already through the gap zone. So some traders might prefer the 10-day, and you could also tighten that up even further, and you might go with maybe a 5-day. Let's see if the 5 day, I'm pretty confident the 5 day is going to show itself here in the lows we've made over the last week. Yep, sure enough. And goodness, you could be working with the 5 day on Alphabet and been okay, everybody. You've had one close beneath it since April 1. That is the kind of strength we're talking about, right? My goodness, that's fun to see. Okay, what else do we have? So we talked a little bit about let's see, the airline stocks. We have former New Hampshire governor's warning. The Treasury Secretary advised, excuse me, former New Hampshire Governor Chris Sununu warned Treasury Secretary Scott Bessent and President Trump advisors that the Iran conflict is driving up oil and jet fuel prices. That's news to all of us. Kidding, of course. But it's likely going to raise airfare and create political risk for Republicans ahead of the midterms and summer travel season. You all know we take an apolitical view in this class and most everything we do on the net channel here for you. But this is important to point out. We all knew this, right? It's why we were looking at airline stocks, generally speaking. They all popped on this headline as a reference. Let's just look at a few of those airline stocks for our purposes here. We talked about the space broadly, but if we look at somebody like Alaska, you can see Alaska Airlines has been under a pretty good struggle here of late. What about Southwest? Well, it could be said that Southwest at least has a floor, right? You can clearly see an area, short run support here, moving off of that ever important 200-day moving average. What about American? American back above the 200-day. United back above the 200-day. Maybe move this line to this spot. This looks like resistance short run. And then maybe even JetBlue. The other thing is, of course, we lost Spirit Air. Spirit is in bankruptcy. So we've lost an entire airline and all of their routes. So that's not a win for the broader market as it relates to travel. You can anticipate an increase to these costs. You know, I think that's the big takeaway as it relates to the airlines, anticipating a move in airfare costs to all of us. We've seen oil elevated by 50% or more. You can expect that's going to come out in the way of costs to us as consumers. There's just no way around that, unfortunately. So what about upgrades today, everybody? I got a big one for you. A company you're probably familiar with. How about Oracle? Oracle moving higher towards that $200 level and the 200-day moving average above us at about 211. We're upgraded today to buy from neutral at a REIT. And they put a price target of 255 on Oracle. Now, of course, we've got an area of note here. We have a gap level. So back in December, the stock had its earnings and we gapped down. And as always, we talk, the gaps are important, everybody. So if we were looking for an approximation for a profit zone, this might be that zone. And it's because we've got a number of key details to consider here. I'm going to zoom in a little bit. Number one, first of all, why is it improving? Well, we've got a couple of ideas, but look, we broke a downtrend. Now we've got a 20-day crossing the 50, 20-day rising. We've made a new short-term high with yesterday's close. So you've got an improving chart, higher highs, higher lows, and this looks nice from that standpoint. And now that we've got the gap above us, some traders will see that we run to the bottom of that gap, or basically the highest point we've been since falling down. And this becomes an area for potential sell. And that's right around 205, 206. So that might be a first area where some traders would take a little bit off. But if you can stick with it, and maybe it rallies into the 200-day, like I said, that's another 5 points up. You could layer your exits here as well. So if you're the owner of some shares that you acquired down in the lows, or maybe you bought on the break of the downtrend line, an area to take a little bit off becomes that first ledge around maybe 195 approximately for some traders, then maybe 210 as the area near the 200-day moving average. And then if you can keep any and it keeps going for you, terrific. Then you can start to elevate exit strategies, raising a stop order potentially to capitalize and lock in what you can on your move. But again, even though this is improving, we should expect a pause potentially in the area of the gap and the 200-day moving average. Not at all uncommon. So I know, like I said earlier, a lot of us traders don't like to trade stocks below their 200-day moving averages, and yet you can still trade counter trend if you do so with a plan and a process. It'll be a lot more comfortable. All right, so they were upgraded. What about Fortinet, another software? FTNT got a big move today. Must be, yep, that's a big earnings play there. So Fortinet was upgraded at BTIG after, quote, outstanding Q1 report. BTIG analysts upgraded Fortinet to buy from neutral with a new target at 125 after the company reported outstanding Q1 results, gave an updated fiscal 26 outlook that was materially better than expected. While the firm's checks heading into the print were positive, they had upticked from prior quarters. They were surprised by the magnitude of the beat, according to BTIG. So they're taking that as a major positive. They've upgraded to buy from neutral and that 125 target, which still represents 15 points of potential upside, even though we know those are not levels guaranteed to be achieved. Let's pull this back into a weekly. Oh my goodness. Well, there's one way to look at things, everybody. This is a weekly chart on Fortinet. That beneath us, this line is the 200-week simple moving average. I'm just going to reiterate one thought, and that is it is often easy to miss the forest because of the trees in front of you. And if we work on our daily chart exclusively, we are going to miss out. We're going to miss opportunities. This is a wonderful reflection of how working along the longer, broader trend can be a comfortable way for us to look for opportunities. This is the max weekly chart taking us all the way back to circa 2010. So we're looking at a long-term chart. Now, does this continue in perpetuity? No, definitively not. But it tells us that if we've been paying attention along the way, there were reasons for traders to have interest in the vicinity of this recent lows over the last year. In the neighborhood of, say, $75 and $80, this was an area where traders should have been looking for exposure to a space that had been beaten up but has managed to hold support. And you can see that clearly on this long range pattern, right? So my hope is that maybe in the future, when we look at these opportunities, we look at it on the daily chart and we go, well, yeah, I know I need the daily, but let's back this off. Let's take this at a larger, longer term window, and let's make sure that we give consideration to the longer trend. We could have possibly learned something about Fortinet here off of the recent lows. I mean, just going back to January, it was at 75. Stock's up 35 points from there, about 50%. That's an excellent move. But again, trend matters, and we cannot be ignorant of the longer range trend. I think it can be very helpful for us as we work to understand where our opportunities lie. Okay, let's look at one more upgrade today, and it was in Alcoa. Now, the materials space has been moving here. Alcoa got upgraded today to overweight from equal weight at Wells Fargo. Wells Fargo upgrading and placing a target of $70 on the stock, up from $67, and stating that the Iran war has worsened an already tight market condition for aluminum. According to the research note, Wells believes the benefit to Alcoa from aluminum price strength is underappreciated at its current share levels, and the firm sees catalysts from the company monetizing their idled assets for data center conversion. So there's another one that's getting a little bit of a lift here today. Thought we'd highlight that. Now the stock itself is not moving necessarily, as you can see. We are up 1%, but we are below the 50-day, below the 20-day. But you could certainly say that we tested support here. This again, a gap ledge for us, so that could be a spot where traders could manage risk. Under this ledge, support probably back at the last lows, and then you've got the 200-day beneath. So a couple of things for consideration there. All right, and it looks like I am just about at time. So with that, let me wrap things up. We did a good look at the broader indices, right? We did see the S&P 500, the Nasdaq 100, and the Russell 2000. We did dive into the software space, looked at a couple of upgrades we got there today. Software on the move, so we'll keep an eye on it for the day. But got to also a number of key stocks in the news this morning on some upgrades and some good charts there as well. As always, you can keep it tuned right here to the Schwab YouTube coaching channel. There's definitely more to come from us. In fact, our next class on deck will be about 45 minutes out, and that is with Connie Hill. Long verticals and diagonals is what's up next, so about 45 minutes or so for that one. Make sure you're following Brent and me on X, Brent Moores, CS, Kevin Horner, CS, and if you're on LinkedIn, feel free to find me there as well. Thanks again for being here, everybody. We'll get this reviewed and into the archive for you shortly after class. If you'd like and you enjoyed the discussion, hit that thumbs up for me down below, which will help us out quite a bit in the YouTube on the replay. We always appreciate your support of the channel, everybody. So with that, have a great rest of your Thursday. I look forward to seeing you all again real soon.